Good evening and welcome to our market wrap. Let's dive right into the numbers. The Nasdaq Composite fell 1.47% to close at 25,881. The S&P 500 was down 0.5% at 75.33. And the Dow Jones Industrial Average eked out a relatively mild loss of just 0.2%, finishing at 52,552. So the big story today was structural divergence, and I mean extreme divergence. On one side you had tech stocks getting hammered. On the other side, money was flowing into safe haven assets in a very orderly fashion. So what triggered the sell-off in tech? The main catalyst was Taiwan Semiconductor, or TSMC, cutting its third quarter guidance. And the market took this very, very seriously. It was interpreted not as a company-specific issue, but as a potential leading indicator that global demand for artificial intelligence chips might be slowing down. This pessimism started during the Asian session. In China, the Shenzhen Component Index fell nearly 2%, and the Chinex board, which is heavy on tech, lost almost 3%. Semiconductor stocks led the decline. By the time U.S. markets opened, Nasdaq futures were already down nearly 2%. Nvidia fell 1.8%. The ARK Innovation ETF, a good proxy for speculative tech, dropped more than 3.5%. It was a broad-based rout in growth stocks. So where did that money go? Let's look at the key indicators. The VIX, which is the fear index, jumped 6.76%. That tells you sentiment did get a bit shaky. But here's the interesting part. The 10-year Treasury yield actually edged up to 4.57%. The US dollar index strengthened by 0.2%. This tells us that investors are not rushing into long-term bonds to bet on a rate cut. Instead, they seem to prefer holding cash or short-term dollar-denominated assets. So the picture we have is stocks down, bonds stable, and the dollar firm. That is a classic risk-off pattern, but it is an orderly one. It is not a panic. Now, there was one sector that actually bucked the trend today. Rare earths and critical minerals had a strong session. The catalyst was China announcing tariffs of up to 35% on certain U.S. rare earth processing materials. The expectation of tighter supply drew money into that space. But we need to watch whether this move has any staying power. If it is just a one-off reaction to a headline, the momentum could fade quickly. Looking ahead to tomorrow, I have a few actionable observations for you. First, I expect China's semiconductor sector to continue its decline. The damage from the TSMC news is not done yet. I am looking at a potential drop of 1 to 3%, unless we see clear intervention from state-backed funds during the session. Second, Hong Kong's Hang Seng Tech Index will likely feel the spillover effect. I expect it to open lower by 0.5% to 1.5%. Third, safe haven assets should hold their ground. The dollar index will likely trade in a range between 100.5 and 101. The 10-year yield should stay in a tight band around 4.55 to 4.6%. So, to sum it up, today's market sent a very clear signal. Money is rotating out of high-risk growth stocks and into assets with more certainty. Until the TSMC-related uncertainty is fully digested, caution is warranted on the tech side. My advice for tonight and tomorrow morning is either to hedge your exposure or simply stay on the sidelines. Do not try to catch a falling knife in tech stocks. Wait for the dust to settle.